Welcome to episode 3 of Damien's Midweek Markets, which is the podcast where I teach you about DIY investing over the longer term. Now this week I'm going to pick up on a whole range of themes, so I'm going to get through them because I'm always conscious of time, and as you know, I like to keep these podcasts to about 10 to 15 minutes. Now, anybody who's an 80/20 investor member, that's my DIY investment service where I teach people how to invest and provide them with fund data and fund shortlists which they can use. I do a lot of weekly commentaries and newsletters and research pieces, and one of the little tidbits I want to take out of there for this week's podcast is about the similarities between the market now in January 2019 and January 2018. I often tell you to grab your stock app on your phone and have a look at markets. Now, if you do that and you go and look at one of the markets, the FTSE 100 or maybe the S&P 500, which is the American stock market, if you widen the time frame to say 2 years, you'll see that at the beginning of January 2018, the market rallied incredibly strongly and everybody was very bullish and it thought that it was never going to end, and we hit new all-time highs. We've had a similar rally in January this year. In fact, we've had a better rally. It's one of the best Januaries on record in terms of returns. And of course, we now know with hindsight, if you look at that chart, what happened in 2018. The market then collapsed as everybody started to panic about slowing global growth. Bond yields were increasing at that point. And there were some similarities between then and now, not just in the shape of that curve, but what was going on in the background. For example, there were fears over a US government shutdown, which we've had all of 2019 so far. Although the government in America has partially reopened, it looks like they may shut down again in February. And it's a similar pattern. I started to draw some parallels and just to look and say, actually, is there more to this? Now, there is a big difference. In the lead up to 2018, the market was actually grinding higher itself. Whereas before January 2019, as you know, the stock market collapsed and we had the worst December in the stock market since the Great Depression in 1931. So it was a slightly different environment, but there are some similarities, and it was just one of them I'm going to pick up on because I can't give too much away on it from 80/20 Investor. But one of the ones I want to pick up on is that relationship between the FTSE 100 and the pound. The strength of the pound in US dollar terms does have a huge impact on the FTSE 100. Now, that's because about 70% of the companies in the FTSE 100 in the UK actually derive their earnings overseas and they are based in dollars. What that means is any earnings they have in dollars, when that is repatriated back to the UK and the currency conversion occurs, when the pound is weak, it actually boosts those earnings in pound terms. So $1 becomes worth more than it did the day before if the pound is falling. So what happens and what you need to focus on is when the pound falls against the dollar. Remember, we talked about that index last week. It gives the FTSE 100 a boost. So that's why the FTSE 100 can perform differently from, say, the FTSE 250, which is more smaller companies and mid-sized companies, which are more domestically focused. So the FTSE 100 tends to rise if the value of the pound against the dollar falls, and conversely, if the pound strengthens against the dollar, it actually means that the FTSE 100 tends to fall. But while that relationship isn't necessarily in lockstep, it is one that happens, it generally always occurs, and you can see that dynamic relationship. What is interesting in investing is if there are these relationships, these correlations, there are lots of them out there and we'll cover them over time in these podcasts, when those correlations break down, because it can be a sign of stress in markets. And in January 2018 we had that, a number of them, different correlations broke down, and the one between the FTSE 100 and the pound broke down. And at the time I discussed it, thought, could this be a bad omen? Decided perhaps it wasn't. But it turned out it was, and that's not long after that, the markets collapsed. It wasn't just because of that relationship was a symptom of what was going on. We've had inklings of that again this year in January 2018. So is it a bad omen for the market right now? Who's to say? We'll find out. But history doesn't always repeat, but it often rhymes. So everybody out there is incredibly bullish at the moment. If you see any commentators, they're talking up the stock market. They think we're going to keep marching to new all-time highs. It's a possibility, but what we have to be is balanced. So you're always looking for the alternative view that you're hearing from the consensus or the one that you hold, to always look for balance. So there are still some signs of weakness out there. Of course, Brexit is muddying the waters when it comes to the value of the pound. If you didn't realise, the pound versus the dollar, that index is a very good barometer of how well the Brexit negotiations are going. So when we have something go badly, in terms of it looks like we're going to have a no deal, then the pound falls against the dollar. So if you want to cut out all the noise and you're just like me and everybody else who is often confused what is going on with Brexit, where we are, keep an eye on the pound. And as I mentioned last week, the pound has actually shown some resilience, some surprising levels of strength that caught a lot of people off guard. Whether that will be maintained will depend on what happens come March the 29th. If we exit with a no deal, you could likely expect the pound to plummet in value. And what that will do is that will mean it could boost the FTSE 100, despite the fact that those UK companies that are in the FTSE 100 may have issues, but because their earnings are overseas, you get that boost that I was talking about. It will also likely mean that any overseas assets you hold, so it could be equity funds in America, will get a currency boost as well, ignoring what they're doing in their own currencies, what the asset is doing in terms of performance, but they might get that nice currency kicker. So there we are. That's one thing to bear in mind. There are still things out there that we're not out of the woods yet, despite what people are telling you when it comes to this stock market rally. If we look at the stock market as a whole, if you look at those charts again, we are still in a downtrend from where we were at the beginning of October, when the Federal Reserve spooked the markets by suggesting that they were going to keep tightening rates and they were going to unwind the QE, that quantitative easing, the money printing, to use another term, over time on almost autopilot. And that's actually caused the market to weaken. And part of it was because of the fears of global growth as well. So we think the global economy is slowing, particularly in China, and there are signs of that. So bear that in mind, that the market is still looking like it's in a downtrend. It hasn't confirmed or broken that downtrend as yet. So we need to do that. And what is interesting, we're still in that area of, if you look at the S&P 500, there's a 100-point range, 2,700 above, 2,600 below, with the 50-day moving average in between that. And we're in this zone where we need to break out decisively above or below those levels to see if we're going to propel back towards, say, 2,800 and then maybe on towards 2,900 and new all-time highs. It's going to be tricky because there's a lot of resistance on the way. Equally, if we go below 2,600, you're going to get nervous because the whole market could start to unravel. But at the moment, there's so much going on in the markets, and this is why I wanted to do this podcast, in fact, because this week is critical. It's Wednesday now as I'm doing this podcast, and there were so many market moving events that come Friday, when the markets have closed, things could look radically different to where they were on Monday, and indeed where they are today. And I'll give you a reason. There were some key earnings reports in America. So we're in earnings season, so the companies tell everybody about how much money they've made in the previous quarter. So that was at the end of 2018. Now, the earnings season's already started, but this week we have more companies than any other week that are actually reporting their earnings, and there's some key ones. Apple. So Apple, who produce all the Macs and iPhones that you love, they were reporting their earnings this week. And there's an adage that goes, as goes Apple, so goes the stock market. And it's because it has such a significant power over the market, because of its size, because if you take all the shares in the market cap, it is a huge beast. It was a $1 trillion company before the sell-off in October and December, but it has a big influence over the indexes. And so everybody was watching to see what would happen, because remember what happened earlier in the month. Apple surprised everybody by coming out and saying, look, our earnings are going to be pretty bad. They're going to be not what we were expecting or what we told you they were going to be. So they revised down their forecast. That caught the market off guard. The market sold off because one of the big things they said, they were concerned about China and Chinese economic growth. You get a theme here. People are worried about economic growth, particularly in China, the second biggest economy in the world. And don't forget, we don't have quite the transparency over economic data in China as we do in other countries. In fact, most people think they just almost make the figures up just as a form of almost propaganda. So we don't have the transparency quite what's going on. That's why people look at things like the price of copper and oil. I talked about oil last week. Oil was an interesting market this week. We actually started to drop towards $51 a barrel, and we dropped to a level which will be something I'll come back to in a future podcast, that started to almost look like that market was going to unravel as well, and we're going to head lower. Again, on fears on global growth and supply and demand, but that almost implied that the global economy was slowing. So we had Apple's earnings this week, and everybody was looking at that because it was seen as a key indicator of the stock market health generally, corporate America, the Chinese economy, and actually, as I talk now, their share price jump is up by about 5% today because they beat expectations. Now, we have to be realistic. These were low expectations because they'd already lowered the bar, but they weren't as bad as people thought, or maybe I should say they hadn't got any worse. So there was almost like a relief rally in that. Again, the bulls out there, the bulls are really being bullish and saying we're going to definitely go higher. There are other companies that are releasing their earnings this week, Microsoft and Amazon, to name two. There's Facebook as well. So look out for those, because those tech giants led the rally upwards for much of the last 2 years, but they also led it down. So if they fail and underperform and don't beat analysts' expectations, it could be negative for markets, but of course if they do, it could be very bullish. The other key thing I want to mention is that we've got the Federal Reserve talking this week. They're actually talking about interest rates and where their view of the economy is going. So that's happening today. And what is important is that a lot of what's going on in the markets has been based around what the Federal Reserve has been saying. So whether they think that they're going to keep tightening monetary policy, basically taking the drugs that the market has been hooked on and trying to, the free punch bowl as people often call it, because the markets are being manipulated by our central banks. There's no two ways about it. So they were going to pull that away, but of course, you pull the rug from under the market, it therefore falls. That's what sparked the sell-off, and actually, along with those global growth concerns in the autumn of 2018. The Federal Reserve are unlikely to want to upset the market, but there have been signs that the economy in America has been doing perhaps a bit better than others had thought. We've had some fairly good earnings. In some cases, Apple wasn't as bad as people thought. So it'll be interesting to see. What you want to look for is at the back end of this week whether we have the market sell off. If it does, then it's probably because the Federal Reserve has said something, particularly around quantitative tightening. So that's basically unwinding QE. That will spook everybody. They would think that all of that money flooding the system that's buoyed up asset prices, and particularly shares, will be disappearing, and therefore the market will fall. So that's something very key to focus on. The other thing I just want to mention before I finish is at the end of the week in America they are releasing their job numbers, and they are going to show how they give basically a bit of a litmus test on how the US economy is doing. Again, that can move markets. So by the end of this week, I think we're going to have a little bit more clarity on whether the market is truly going to head higher, which is it needs to break through 2,700 on the S&P 500, which is going to be tricky, but once it does, then it's going to give it presumably upward momentum to go higher, or if we're going to break lower. So there's a lot to watch out for this week on markets, and when we talk next week, we'll be somewhere out of this flip-flopping market where we're in this condensed zone where the bulls and bears are fighting. No one really knows which way it's going to go, and it almost feels like it's on a precipice. Of course, there is the alternative scenario. We could just bounce along like this for a number of months, but at the moment, we don't know. And obviously, keep an eye on those Brexit headlines. So, as ever, thanks for listening. If you want to get in touch with me, you can do. You can do it via Damien at moneytothemasses.com, or you can do it via Twitter, moneytothemasses with the number 2, and of course Instagram. Find me on Instagram, Money to the Masses. I'd ideally love you to talk about the podcast on social media, and we're actually trying to run something that if you listen to any of our podcasts, so this podcast or a podcast on Sundays, please take selfies of yourself doing it and tag us, and we'll share them and write to us, because we want to try and really push this out there. And thank you for all your support and feedback on this new podcast series. So until next week.